Goldman Sachs says that the stock market boom is just getting started. Take a look. In 2022, Goldman Sachs said that we had a 35% chance to enter a recession, but fast forward to today, Goldman Sachs says that never mind, there's only a 15% chance that we're going to enter a recession. But they're not just predicting economic growth, they're also predicting stock market growth because they're predicting the stock market's going to continue booming through 2025. And there are two main reasons why Goldman Sachs says that our economy and stock market is going to continue to boom. Number one, the job market, because we've been blowing past expectations, although the most recent jobs report came in not as good as expected. And secondly, because inflation is something you no longer have to worry about, although the most recent inflation report also came in a little bit hotter than expected. But the reason why this matters and the reason why I'm making this video isn't just because of what their prediction is, it's because on the other hand, the Federal Reserve Bank says that they want to continue cutting interest rates in 2024, they want to keep cutting interest rates in 2025, and they want to also cut interest rates in 2026. Now this is where I think a lot of people understand the general implications of this, but not the full implication. Because generally the Federal Reserve Bank cuts interest rates as a way to stimulate the economy when you're seeing economic slowdowns. When you're already seeing economic growth, when you're already seeing stock markets rise and you start cutting interest rates, that could potentially lead to an overheating of the economy, which could also make the inflation problem worse. And to really understand this, let me show you how our economic system works. There are three main entities in our economic system. You have the CIB, the consumers, the investors, and the business owner. Every single person, rich people, middle class people, poor people, everybody's a consumer because everybody's got to eat, everybody needs clothes, everybody has a car, etc. Some people become investors. Investors are the people that own a piece of the businesses. And the way that our economic system works is consumers. You, me, everybody goes and spends money at a business. You go to Chipotle, you buy the extra guac, you spend money at the business. Who does that benefit? Obviously, that keeps people employed, but that also benefits the investors because that means the profits go to the owners of the business. And who is the owner of the business? That's none other than the investor. Well, the question then is, what happens when you see inflation? We saw this happen a lot over the last 5 years. When you see inflation, that means consumption becomes more expensive. When consumption becomes more expensive, that means more dollars have to go into the hands of the business. You have to pay more money for your groceries. You got to pay more money for your guac. You got to pay more money to buy a house. You got to pay more money to buy a car. Things get more expensive. When more dollars go into the hands of the businesses, more dollars go into the hands of the investor. What does that mean? Inflation disproportionately benefits the investor while disproportionately hurting the consumer. Now, every single investor is a consumer. But not every consumer is an investor. In fact, most consumers are not investors. Most consumers are only employees. And so if you are just an employee, that means now you have to rely on growth in your salary to keep up with this added cost. And the problem with this is we have seen growth in salaries over the last 5 years and over the last 50 years, but the growth in salaries here into the hands of consumers have not kept up with the growth of prices of things. What does that mean? Investors get richer. The average employee who is just a consumer gets poorer. And so now when we're in a situation today where the Federal Reserve Bank says they want to continue cutting interest rates, to continue stimulating the economy, to continue making the job market and the economy stronger during a time where markets are already booming, during a time where the economy is still growing, during a time where unemployment is still low, could that risk overheating the economy? Could that risk making the inflation problem worse? And we know, we can look at any time period over the last 50 years, that when you see inflation happen, the investors benefit disproportionately better than just the employees. And so now we have to wonder, well, we've already seen the big impacts of inflation over the last 5 years. What's going to happen over the next 5 years? This is why I'm such a strong advocate of financial education, so you can become an investor. But with that, let's dig a little bit deeper into the Goldman Sachs report and what they think is going to happen to the stock market in the future. And of course, if you are an investor and you want to stay up to date on what's happening in the financial markets, Market Briefs is a free resource that I created. It's a free daily newsletter where every day my team is breaking down what's happening in things like the economy, the stock market, the real estate market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. We create it in less than 5 minutes shares every morning and it's completely free. So if you have not joined Market Briefs yet, I got the link for you down in the description below. Let me show you what Goldman Sachs has to say about where the stock market is going, and then I'm going to put this all into perspective. The firm Goldman Sachs predicts that the S&P 500 will reach 6,000 points by the end of the year and 6,300 points by a year from now. If Goldman predictions are correct, the broad stock market index could increase by 4% through December and 10% over the next year. Now look, I gotta give you the disclaimer. Okay, I'm just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Over the past year, the course of 2024, year to date, the stock market, more specifically the S&P 500, is up by around 20%. Over the last 5 years, we have seen the S&P 500 grow by over 90%. And over the last 50 years, assuming that you reinvest your dividends, we have seen the stock market, the S&P 500, grow by more than 22,000%. But to really put that in perspective, let's compare the growth of the stock market with the growth of incomes. Year to date, a generous expectation of household growth is 4%. I calculated 4% because over the whole 2023, we have seen median household income in America grow by 4%. So I'm just going to use that same number for 2024 year to date, although wage growth has actually slowed down in 2024, but I'm going to be generous. Over the last 5 years, we have seen household income in America grow by around 20% on average. And over the last 50 years, we have seen household income in America grow by a little under 700%, which means household income in America has grown. It hasn't kept up with the prices of things. We know that. And this helps explain why we've been seeing a wider wealth gap. We've been seeing the financially educated, the investors, see their asset prices boom over the last number of decades versus the average person's salary hasn't even kept up with the price growth of things. And again, this is where you have two options. You can complain, cry, kick, scream, hate the system, or you can learn the system, learn the rules, and start being an investor that we can actually build wealth in this economic system. Now, of course, I want to lay this out there that markets do not always go up. Over the course of the last 50 years, and even the last 5 years, we have seen recessions, we have seen market crashes. They are a part of our economic system. But despite the market crashes, despite the recessions, despite the wildness in the markets over the last number of decades and years, we have still seen the stock market go up when you look at it over the long term, which is why you got to be a sophisticated investor. And of course, not everybody agrees with Goldman Sachs. Take a look at what a rep from the JP Morgan Asset Management Division had to say. I am getting increasingly queasy about the fact that the equity market keeps on pricing in a soft landing. What does that mean? He's getting worried that the stock market, which is the equity market, is pricing in the fact that there will be no economic slowdown at any time in the future, which means when sometimes people think that nothing can go wrong, that's when things can go wrong. Now, I want to go back to what the Federal Reserve Bank is saying, because let's tie this all together now with the discussion of inflation and markets. Because the Federal Reserve Bank, now we know that not everybody is in agreement to keep cutting interest rates significantly. We've seen some dissent in the Federal Reserve Bank on how aggressive the Federal Reserve Bank should be cutting interest rates. However, the reason why I want to put this all in perspective is, of course, there's a couple issues at play here. Number one is market values growing faster than income values. This is going to continue happening. This has happened in the past and it will continue happening in the future. What we don't know is what the Federal Reserve Bank is going to do and what's going to happen in the economy tomorrow. Do we have red flags? Absolutely. But you need to be financially prepared so you can capitalize on whatever happens in the markets. What does that mean? Well, depending on what continues to happen with inflation, depending on what continues to happen in the job market, it might dictate what the Federal Reserve Bank does. Now, regardless of what happens in the news, if the Federal Reserve Bank continues to cut interest rates, and if we start to see more heat in the economy, and if we start to see more inflation, we know who that can benefit. Now, of course, we have seen times of stagflation. Stagflation is when you see a slowing economy, a slowing job market, and also the prices of things rising. That is the worst case scenario. But what you want to be prepared for is no matter what happens in the markets, you want to be able to capitalize on things, and that means having money to invest and then looking for opportunities to invest in. That's what financial education is all about. Now, the way you invest is going to depend on your strategy. There are two general ways to be an investor. I'm not talking about trading, I'm focusing on investing. You could be either an active investor or a passive investor. A passive investor, some people call this dollar cost averaging in the stock market. This is where you set a set it and forget it system, where every week, every 2 weeks, every month, you're just investing your money into the markets, into broad index funds, ETFs, or mutual funds. If you are one of these passive investors, which I think 98% of America should be, because most people don't know how to analyze an investment, and most people don't know how to manage an investment through crisis, because we know crises happen. But if you are a passive investor, what you want to understand is you set it and forget it. If the markets are booming, you keep investing. Markets are crashing, you keep investing. If it's raining, you keep investing. If the sun is shining, you keep investing. That's how you win here. If you don't start panicking when things go wrong, if anything, you want to use this as an opportunity to potentially buy even more. That's how you win as a passive investor. If this is you, who cares what's happening in the news? You just keep investing and you let the markets do their thing. And as long as the economy keeps growing and as long as markets keep growing over the long term, you build wealth. Active investing is a little bit different. Some people call this fundamental investing, where now you're looking for investments, sometimes individual companies often, and you're looking for a good price. Now, what you want to pay attention to is trends happening in the economy. Sometimes these are broad market trends, like a stock market crash happening, where now pretty much everything is on sale. Sometimes it's more specific trends, shifts in the economy. You see an opportunity in technology, you see an opportunity in healthcare, and you find a stock or company to go out and invest in. Maybe you're investing in real estate, you're looking for individual real estate deals. But this is where now you want to pay attention to what's happening. That way you can take advantage of a good price point to come in and buy. But the key is you got to know your strategy and you got to understand what's happening. That way you can be a more sophisticated investor and not get caught up in all the emotions, because there are so many emotions out there. That's why I created Market Briefs, because Market Briefs is one newsletter and we don't have to get into all the sensationalism and all that hypey stuff, because all the news is there. We can just tell you what happened in an unbiased way. So if you have enjoyed Market Briefs, I got the link for you down in the description. But this is why, again, you want to be an investor. That way you can take advantage of the way that our economic system works. The economy is booming. The White House says so, the Federal Reserve Bank says so, even the economists on Wall Street say so. But there's a hidden risk here that no one's really talking about. Let me show you. On one hand, the Fed says the economy is strong, and then on the other hand, they're cutting interest rates. Normally, the Federal Reserve Bank cuts interest rates as a way to stimulate the economy.